Welcome everyone to our final session of the day, and if I dare say, we've saved the best for last. Our next guest sitting next to me is one of the world's most respected and original thinkers about markets and money. Russell Napier is not just a market strategist, he's a historian, an author of the classic Anatomy of the Bear, founder of the Library of Mistakes, which we're going to talk about, based in Edinburgh. And he's also the guiding mind behind The Solid Ground, which is a publication read by investors and central bankers alike. For over 3 decades, he's helped institutional investors and governments navigate the cycles and crises and transitions, but always with an eye on history and a knack for seeing what many others miss. Today, he'll help us make sense of a world that's being quietly but fundamentally changing in many ways we may not even realize. Please join me in welcoming the unique Russell Napier. So, Russell, before we dive into the markets, I first love to start with your personal story. How did you first find your way into the world of financial markets and how it overlaps with history and macro analysis?
Yeah, thanks, Wayne, and thanks for inviting me. If you look me up on the internet, I'm often described as the Scottish economist. There's only 2 problems with that. I'm not Scottish and I'm not an economist. But apart from that, it's very accurate. So, and that sort of explains why I do what I do. So I'm from Northern Ireland, born in 1964, so lived through something that was euphemistically called the Troubles. And had to live with that. So it gives you a slightly different view on risk and uncertainty when you don't know whether you're coming home at night. So a slightly different view of risk. But anyway, I passed a lot of exams in law. This is why I'm a financial historian. So I passed I get 3 degrees in law, but then and then I get a job as an investor. And I know absolutely nothing about investment, so they give me all these books on economics, and I start reading the books on economics, and it doesn't really explain what I see happening on my screen every day. Also, I used to be a butcher because my father was a butcher, so I worked in a butcher shop. Nothing in the economics books explained anything that happened at a butcher shop either. So I thought, my learning curve is going like this. I'm about to be unemployed. I need to steepen that learning curve to understand what's happening on the screens. And I started reading financial history. And I find every time I read a book in financial history that the curve may not be as steep as it once was, but it's still going up. And that is how I began to educate myself, basically from scratch, to do what I do today. So the focus is on history, but on money and credit and financial markets and history. But I do that because I'm a lawyer.
Wonderful. And I've heard there's a library mistake story that's kind of funny and telling about how you think. Would you mind sharing it?
Yeah, well, the Library of Mistakes has got a funny name. But it's actually a business and financial history library. And if I called it a business and financial history library, nobody would come. So we call it Library of Mistakes. The one in Edinburgh, Pune in India, Lausanne in Switzerland. I've just launched one in Montreal. Well, we're looking for funding for Montreal. We've got some, we're looking for more. So Montreal, as you know, we've had a few discussions in Toronto. But the reason for it is really very simple. A time came when somebody thought investment, economics, and finance are a mathematical pursuit that can be put into a spreadsheet. And the world is the worse for it. And now when you look out the window, whatever's happening, and I will mention the word Trump, you put him into a spreadsheet. Let's build a spreadsheet around Donald Trump. So there's other things going on here. There's sociology, there's philosophy, there's psychology. And I find that reading financial history is just a nice, easy way to get there. So the Library of Mistakes is to, build it and they will come is nonsense. We build it, we call it a Library of Mistakes, people come, and we've got a really great community of young people as well who know that economics is wrong, that formal economics is wrong. They know it, they feel it, they want to change it, so we can at least look back to the past as to some other systems, some other ways it's worked, as a guide to how it would work, how it could work, and maybe how it even should work.
So we're in a time of big transitions. You've written about the new global monetary system. You also said that the big story isn't what's in the headlines, but rather it's the restructuring of the global monetary system. Could you tell us what do you mean by that, and what does the new system look like?
Sure. So the old system didn't have a name, so we kind of assume it doesn't exist. Paul Volcker used to call it the non-system. Previous systems had been agreed in hotel rooms, mainly by men, whether it's Bretton Woods Agreement, the gold standard. But this one was agreed by China. China devalued its exchange rate in 1994, pegged its currency to the United States dollar. By 1998, lots of people are joining in. What this does is create the world that we've all lived through. It's a world where China and the Chinese central bank and others are buying lots of treasury securities. They're depressing the yield on treasuries. The money they're creating in China is being lent by the banks for more capacity. That's driving down global inflation. American corporations move their productive capacity from America to China, and this goes on and on and on until you end up with these massive imbalances, and the imbalances are pretty obvious. Debt, huge amounts of debt. America is one of the least indebted countries in the world. We might come back to that, but it's still excessively geared by its own standards. Extremely high asset prices is what we also have, extremely high equity valuations, and that can just go on until it stops. And now it's stopping. And what we're left with are the legacy imbalances of the old system, and the question we all have to ask, and it's the title for this talk really, is how do we get from this excessively high leverage system to a lower leverage system? How do we unwind the legacy? And that will help us work out what the new monetary system looks like. Systems, I should say. Systems, because there'll be a Chinese one and there'll be an American-centric one. And for the avoidance of doubt, I think Canada's in the American-centric one, despite the speech last week by the Prime Minister.
Right. We're both old Hong Kong hands, actually. We spoke about that, having spent time. And I want to follow up a little bit on your comment about China. It's reshaping the system. What are the implications for inflation, rates, currencies? How should we be thinking about what China's doing?
Yeah, so there's a great story today, actually, which explains where we've got to with China. So the German government today is going to pay its telecoms companies to rip out and destroy the Huawei equipment it already has. And that's going to cost the German taxpayer $2 billion US. I didn't see that in the spreadsheet. In other words, the West has become so distrustful of China that it's even prepared to junk $2 billion worth of telecom equipment. We in the United Kingdom are really deciding now we're probably not going to let China build wind turbines. I don't know what the danger is in a wind turbine, but anyway, so if you get to that stage where even wind turbines are unacceptable, we're getting to a stage where we're not going to deal with China. And China knows this because it's dealing with it. I mean, this is not about America. The Europeans have got a 50% tariff on Chinese steel. The Europeans have got on Chinese medical devices their tariffs. And there's a third one, EVs. The European. This is not about America acting alone. So China has to find a new way of doing things because it has gross excess capacity. One of the reasons it's selling stuff so cheaply. So there are two ways you can deal with that: create demand, destroy capacity. And we know as of last August, they really tried to drive up demand by launching a reflation program at the People's Bank of China, but that was cancelled in January. And now they're talking about destroying capacity. So when two tribes go to war, to quote from an old song, both can lose. And both are losing. But to be clear, this was happening anyway. Europe wants to get to net zero. Why wouldn't it just buy all these cheap solar panels from China and get to net zero? Well, it's not, because it doesn't trust them. So this level of distrust means that China will have to go its own way. And when the rubber hits the ground for investors, that means a flexible Chinese exchange rate. China's going to have an entirely independent monetary policy, destroying this old system, which was this link between the dollar and the renminbi, and we're going to live in a new world. So it's not, to me, a world of deflation if you keep slapping tariffs on China, and that's the new geopolitical reality. That's a world where we have inflation, because we simply can't live with the geopolitical impacts of China dumping material and wiping out indigenous corporations and indigenous businesses. That's acceptable if we trust China, but all the evidence is that whether you're Germany, Britain, America, or maybe Canada, we don't trust China anymore.
So just to keep on with that historical theme, you've drawn some parallels between today and post-World War II, which was a time of financial repression, capital controls and industrial policy. Certainly rings a bell. What are the most relevant lessons from that era for today?
Yeah, so just a brief description of what that era looked like and why we have the conditions for that. So after the war, obviously the condition is excessive levels of debt relative to GDP, particularly in the government sector. Today, it's worse. Quite often, if you're reading or looking in the newspaper, you'll see a chart of debt to GDP. And they call it debt to GDP, but it isn't debt to GDP. It's government debt to GDP. If you add in the private sector, Canada's debt to GDP ratio is 305%, if you add the private and the public together. Now, this is worse than World War II, and most countries are worse than at the end of World War II. So now we've got to work out how to solve the problem. So there are 5 ways to solve the problem of excessive debt. Austerity, which is never popular with the people. Default, well, Lehman Brothers was a default. It didn't seem to work out too well. The Greeks defaulted on their debt. It's taken a long time to get back to growth. You then have very high real growth, which is what we'd all want, and that needs a productivity revolution. Then finally, there's this thing called financial repression. The problem for all of us, it's politicians who take these decisions. So to be clear, what financial repression is and was in Canada after World War II is forcing savings institutions to own a lot of government bonds at yields that are deeply unattractive relative to the rate of inflation. And that is it. Now, most people think inflating away debt is just creating more inflation. It isn't. It can't be. It needs an entire structural change in the system. You have to get people into the debt markets, even though they don't want to be there. And it's easier than it's ever been. Most of my friends think it's more difficult. But the wealth of a nation at the end of World War II, the wealth of the people and the grandfathers of the people in this room was held in their own names, generally speaking. And now the wealth of this nation is held by financial institutions. Maybe not the people in this room, but most of the wealth of Canada is held by regulated financial institutions. And last week, what did the Prime Minister say? He said, I want you to bring that money home. I don't want you to be investing so much money overseas. I want you to invest it in Canada. Now, I think if I told you that was going to happen 10 years ago, you'd have said, you're insane. There's no way that the politicians would ever intervene with the free movement of capital in and out of Canada and capital allocation of the Canadian pension system. But it's happening, and it's not a Canadian phenomenon. It's a global, developed world phenomenon. So that's a world where you don't make money in bonds in real terms. I'll run off the asset classes, and then maybe we can talk about, specifically. So if we're not going to be dealing with China, there's a huge capital expenditure boom coming, one of the biggest in history. We have to build all the capacity we're not going to buy from China. Those are equities. They don't dominate the stock market indices, but they are there, they're listed, and they've been shunned and avoided for years because who wanted to buy a company that competed with China? There's also gold. Japanese equities look pretty good. They tend to be aligned with that industrial capacity story. They'll also be inflating away debt. But what we're looking at is the countries that are repatriating capital, that have overseas surpluses to bring home to run this industrial policy. And then you have to be very worried, well, who's got the deficits? Who loses out in a world where capital returns to home base, to buy government bonds, to fund industrial policy? What are we selling? And the answer, 2 answers. America and France. And I think the problem is people are not paying enough attention to France. So a return to home base means a long-term, prolonged liquidation of the S&P 500 in the Treasury securities, but also real problems for France.
Okay. Well, to pick up on that, I'd like to develop a little bit about the implications for investors and for our families here today. You've also said no bonds, no S&P 500, but rather value equities, real assets, and gold. Could you continue walking through your asset allocation that you see that makes the most sense for the future?
Sure. So this financial repression, which we have run before, has so far never been run without capital controls or exchange controls. So far, we've never done that. So one of the things everybody has to think about is where you're going to spend your money, because your money could get trapped somewhere else. It may be that the best value in the world is an Italian bank or a French bank, but if your money gets trapped there, well, we're just going to have to go to Italy and France and enjoy it and use the money. So this is a different game we're playing. We go from playing chess in 3D to 2D. So you need to consider where you want to have your money. To be clear, the government of Canada will never stop you bringing your money home. Capital controls are like a lobster pot. You're allowed in, you're just not allowed back out again. So you want to think about where can I have the money that when I liquidate that investment, I can bring it back to Canada, because you will want to spend money in Canada. And there are not many places that will do that. I think Singapore is one of them. It's got a country with too much capital. So we're going to run through the asset classes, but we're now playing on a bigger scale here, where you actually have to think about where I hold this wealth. Will they allow me to take that money out? Will I be allowed to get it and bring it back into Canadian dollars to buy a home or a house or something for my grandchildren? So we have this previous period. Gold was not floating during that period from 1946 to 1971, but when it did float, it sure as hell made up for it. So gold, I think, can discount lots of things, and from 2007 to 2008, went up 40% to discount a debt crisis. We've seen in recent days it's clearly been discounting geopolitical volatility. When it looks like Trump's making a breakthrough with Xi, the price of gold goes down. When it isn't, the price of gold goes up, so it can protect you from that. I think it can protect you from capital controls. Gold can move more easily cross-border than regulated financial assets. Finally, I think it's also a defense against the debasement of private sector property rights. And let's remember that's what financial repression is. The state is tapped out on debt, so it comes to the private sector and says, we need some of your cash flow. And this is what Trump's doing, whether he's doing it with Intel, whether he's trying to leverage these Japanese corporations, whether he's trying to bribe the Korean government. You know, we've got this going on over and over again, that if you own some of these Korean corporations, it looks like that America owns some of your cash flow. So the more every instrument you own, every single instrument you own is ultimately backed by the cash flows of a corporation or a government, except gold. It isn't. So I think one of the reasons it's going up. Now the problem with all of those things, I haven't even mentioned inflation yet. Usually when people talk about gold, they talk about inflation. In the long run, there'll be inflation as well. So in this, if gold can discount all 5 of those things, you ain't seen nothing yet.
To keep on with that theme about forward-looking, many people point to AI, crypto, and technology as the defining shifts of our era. You suggested that's not the real story. Why not?
Well, it's not the real story, because if you want to make money, you have to go for the unknown story. The greatest known story on the planet now is AI. We have had lots of these technology booms before, and they begin with a massive capex expenditure. You probably know today that just went into the stratosphere with Zuckerberg committing even more. But then either the market or the board, and it's very rarely the board, it has to be said, it's the market, begins to work out how on earth are you going to get a return from the capex. We look around the world to find out what business will give us a significant income stream to justify all of that. And at some stage we begin to work out that at least in a 4 or 5 year time frame, there's far too much investment and no likely business, and it rolls over. That's a very well-worn pattern. It happened in the dot-com bubble. Amazon fell 90% when that dot-com bubble burst, even though it was the right answer. So this isn't the same thing as saying AI isn't a thing. It's just saying that there's a pattern with overinvestment initially, collapse in share prices, then you can look to buy. Meanwhile, we've got the most obvious capital cycle charging ahead, which is building capacity to decouple us from China, and no one's talking about it, and no one's investing in it. And therefore, the valuations of our AI stocks are stratospheric. And the valuation of these other stocks, well, they're extremely low, because everybody says they're value stocks. They'll never compete with China, and we don't want to own them, and they're small and they're illiquid. So there's this tremendous opportunity to make money. So it's not saying that AI isn't the real thing that's going to change the world. It absolutely is. But it's a known story. The unknown story is this story of all this other stuff. And that's, to me, that's more exciting than pointing at the obvious party. We need to look at. So for those who don't know, there's a couple of books on the capital cycle. And the capital cycle is this relation between financial capital and its ability and willingness to fund physical capital. And the basic principle is you have to find an industry or a sector where financial capital has not funded any capex for a long time and buy it. Well, I think there's actually a lot of that around, and that's where you should be looking to invest. You cannot say that financial capital is not prepared to fund data centers.
Right, certainly. You've compared our situation today to sitting in a room in 1968, which you just alluded to, having to decide how to allocate capital without knowing what the decades ahead have to offer us. How would you advise investors today about moments like this while the ground is shifting underneath them? What are some of the pieces of advice or key decision points we should be making?
Yeah, so I picked 68 because obviously the Bretton Woods system ends in 71. So this is tantamount to the same thing, a whole change in the structure of the global monetary system. And we know now what you should have owned in 1968, which was, it turned out that equities didn't defend you from inflation. In 1977, Buffett writes an article called How Inflation Swindles the Equity Investor. So you were sitting in 68, you're sitting with bonds and equities, and both lose you money. So what should you have done? Well, what you should have done is had gold. You should have owned commodity stocks and actually value stocks. Value stocks didn't lose money in real terms through that period. Now, what was the chance that anybody would have done that in 68? If all of your competition was 60-40 bonds, equities. But were those three assets dangerous? Was gold dangerous? Were value equities dangerous? Were commodity stocks dangerous? Well, they weren't dangerous. So what you had to do was not own dangerous assets. You had to own them in dangerous quantities. And that's what I'm suggesting today. If I, as a professional investor, came to anybody in this room and said, you know that guy who's got 60-40 bond equity for you? I'm going to have all of it in gold, value stocks, and run a portfolio like that, no bonds and gold. You'd say I was running the riskiest portfolio in the world, but the three asset classes are not risky, but the quantities are risky, but they're only risky compared to what everybody else is doing. So the fundamental thing at a structural change is not to be intelligent particularly, but it's to be bold in asset allocation. And you might get it wrong, but you don't end up with three assets that are going to zero if you have value stocks which are already cheap, gold, and no bonds. And no bonds.
Fantastic. It's been a long day, so maybe we'll just wrap up now with this last question. If you could leave this audience with one principle for preserving wealth in an era of capital nationalism and financial repression, what would that be?
Read more financial history would be the obvious thing. Read about that period from 45 to 79 and go through some of the things that came along, because all the red flags are flashing. How do I get everybody in this room to buy more government bonds? Well, maybe if I put rent controls on property, bonds would look more attractive relative to property. Property lose their little inflation protection bit. So there's a very clear path being set here. But it's the one I've just said. You have to be bold with asset allocation. And secondly, you have to recognize that the free movement of capital cross-border cannot be taken for granted. And there are some people, because I'm old enough to remember when it couldn't be taken granted. There's some people in this room who are old enough to remember it. There's a lot of young people here who probably think it's impossible. But in that world, where are you allocating to? Right. Don't assume that the last 30 years is any guide to the next 30 years, because we're certainly not in Kansas anymore.
Right. Well, that's brilliant advice. Russell, I'd like to thank you for helping us make sense of these chaotic times when things are changing so quickly. And as a small token of our appreciation, we have a small gift for you. There you go. Great. With the Scottish flag. You're very welcome. Do we have a picture? There we go.